After the epic run in the averages, is it time to get more cautious? With the S&P 500 above 3,000, do we need to pull in our horns? Hey, it's a good question. So now we're going off the charts with the help of Carley Garner. She's that brilliant technician who's the co-founder of Carley Trading and the author of Higher Probability Commodity Trading. We need a more quantitative, let's just say, empirical look that's not emotional to get a read on this market. Ever since the meltdown late last year, remember that's the pal bear market, Gardner's been bullish on the stock market. That's one of the reasons why I like her. She's been dead right. But all along, she has been using 3,000 as her target for the S&P. Well, here we are. Now Gardner thinks it is time to get more cautious. I like a person who, when they hit the price target, doesn't just say, let's bump the price target. She rethinks. Why? She says there's a legitimate argument that much of the good news is already priced into the market. Look, we're already expecting multiple rate cuts from the Fed, right? We heard that again today with Steve Leisman's interview. We've got record unemployment. It's the longest economic expansion in U.S. history. And people also predict a certain amount of progress in negotiations with the Chinese, which we certainly didn't get today. And that's why Gardner believes we're due for a breather, not a disaster, a breather. Let's go through our argument point by point. First, take a look at this chart, which shows the pattern of seasonality in the S&P 500 over the past 15 years. Well, the old sell in May and go away saw, that hasn't worked in ages. There are other seasonal trends with a lot more staying power. Gardner notes that the S&P tends to peak in late July. Okay, this is historical patterns over a 15-year aggregate. Late July, and then trade down through late August. Sometimes that weakness spills over into September and October. In most years, it's followed by a terrific rally, although that's certainly not what happened in 2018 during the pal bear market. And that's the thing about betting on seasonal patterns. They're far from a sure thing, but they happen more often than they don't. Definitely something to keep in mind. The real crux of Gardner's thesis, though, is sentiment. We often hear that this rally is hated. But is that true? She says the truth is it's only hated by the vocal minority of money managers who've missed it and desperately need stocks to go lower so they can catch up with the averages. Gardner points out that the consensus bullish index reports that over 60% of industry insiders they polled are bullish. Over 60. People like this market, which is not what we want to see. Remember, we want people who don't like it who have to be converted to bulls, not bulls who get converted to bulls. They're already there. At the same time, take a look at the CNN Money, Fear, and Greed Index. I like this one. Measures put-to-call ratios, volatility, momentum, junk bond demand, give you a rough gauge of sentiment. On the one hand, the Fear and Greed Index is definitely in greedy territory, okay? On the other hand, though, it is less greedy than we've seen in previous rallies. You could argue this means that the market is more upside. Garner's more concerned with the trajectory here. She points out that the Fear and Greed Index has been making lower highs and lower lows, which suggests that the potential upside here is probably limited, at least for the time being. This chart did not make me as fearful as she seemed to indicate, but that's okay, because we're looking at an aggregate group. Like, what else? As Gardner told us at the end of May, speculators may have gotten ahead of themselves with their predictions for multiple rate cuts this year. I like what I've been hearing from Fed Chief Jay Powell, said that at the top of the show, but if we only get one rate cut or even two, maybe there will be people disappointed. That's nuts, but there might be. How about earnings season? The fact is the averages have rallied coming into this earnings period, and she says that's rarely a good sign. Gardner points out that the general pattern going into earnings is usual a counter-trend move. In other words, if the S&P pulls back into earnings, it's likely to bounce after we see the numbers. I've been telling you this myself. If it rallies in earnings, it's likely to dip on the actual results. That's one more reason Gardner thinks the path of least resistance for this market might be lower, at least for the time being in the near term. Okay, now I want you to check out, let's get technical here. Let's check out the chart of the E-mini S&P 500 futures. All right, this is really, I know, I mean, it's kind of a Mondrian meets Rothko here, but there are a few salient issues. First, the S&P is brushing up against a powerful ceiling of resistance. The trend line that began at the climax of the historic 2018 rally suggests that the S&P has a ceiling somewhere between 3,035 and 3,060. Now, given that it's currently trading at 3,004, you could easily argue that there's not a lot of upside left, okay? Second, look at the relative strength index of the RSI down at the bottom, okay? This is an important momentum indicator that's currently hovering in the high 60s, nearly 70. Once again, it breaks above 70. We're in overbought territory. Gardner notes that the S&P is rarely capable of maintaining price levels after that happens. By the same token, the Williams percentage R indicator, that's an oscillator, which tells you when a security has gotten overbought or oversold, is an extreme overbought territory. It's something that my friend who writes to be at Real Money, Helene Meisler, pointed out, and she's been one of my favorite technicians since the 80s. So this suggests the S&P has come up too far too fast. When both of these oscillators are extreme highs, you often see the same pattern. The buying starts to dry up, and a correction, there's the key word, begins. So let's say Garner's right that we may be due for a pullback. How deep could it be? Well, that depends on the news. But she wouldn't be shocked to see the S&P plunge down to the mid-2700s. That's big. That'd be a pretty, it's a pretty normal trading range, given that we've got a floor of support at 2750. Of course, if things get really bad, she thinks that we could drift down to 2470. But she doesn't expect to see either of those levels. Those would be serious corrections. How about the NASDAQ 100? Look at that one. This is the 100 largest non-financials NASDAQ composite. Let's take a longer view with tech and look at the NASDAQ 100's monthly chart. So you're going back all the way back to 2009. Right now, the NASDAQ 100 is attempting to break out above the ceiling. I mean, this is pretty important move here. And the resistance level is 7,835. Now, we're already above that level just today. But this is a monthly chart. So we need a monthly close before the breakout is what we call confirmed. For Gardner says mixed picture. On the one hand, she could see the NASDAQ 100 make a break for 8,455 in the near future. Not bad. The next ceiling resistance. In fact, when we checked in with her in April, she specifically told us that a breakout above 7,835 would likely lead to a sharp run up to 8,455. That would be a 6.6% gain from these levels. Remember, she's been bullish the whole way. However, Gardner also notes that breakouts can be tricky. Sometimes breakouts are fake outs. Putting it all together, the pace and the trajectory of this tech rally is like nothing we've seen since the dot-com bubble. That doesn't mean the NASDAQ 100 can't move still higher, but it does give Gardner pause. She thinks the odds of a further rally beyond 8,455 are very low. Not only will we run into resistance at that level, but all sorts of indicators will start flashing red. Right now, the RSI is around 65. We'll absolutely cross above 70 if the NDX rallies another 500 points from here. And as I told you before, that's overbought. And the Williams percentage R oscillator is already nearing maxed out levels, not just on the monthly chart, but also on the daily and the weekly. Now, Garner says the Williams percentage R can stay overbought for a while before it triggers a sell-off. But this reading is definitely something that should make you more cautious. If she's right, if the rally stalls, or if we get all the way to 8,455 and then turn around, what comes next? Garner says she'd expect a normal correction, which would take the NASDAQ 100 down to 6,700 or 5910. Normal correction. I say, ouch. Let me give you the bottom line from this whole picture. After the epic run in the averages, the charts as interpreted by Carley Garner suggests that the upside in the stock market has gotten more limited. Remember, she liked it all the way down. This is substantial. But it's possible she's being too cautious. Her general point is correct, though. The risk reward up here, it's simply not as it was good a month or two ago. That's the important takeaway, and stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.